good, YouTube? It's your boy Charles Enoch. You already know we back with another Invest in Myself episode, baby. So roll the clip. So today I want to branch off of last week's episode and go over how to pay off multiple credit cards with a small line of credit. But before we get into it, you already know your boy has to do the YouTube thing. So I'm getting close to being monetized. So I'm gonna ask you guys, help a brother out. So go ahead, take a little time, smash that like button for me. If you're new to the channel or you just haven't done so yet, go ahead, take that time, hit that subscribe button for me. Also, please consider joining my Patreon channel if you enjoy my videos. I appreciate anybody that does these steps because it does help me reach a higher audience base. So we already know that both a line of credit and a credit card are calculated by simple interest, which we know that you can pay off simple interest a lot quicker than you can pay off amortized interest. Which this raises the question, why would we pay off a credit card with a line of credit if both of them are calculating interest in the same way? Well, the answer to the question is a lot of individuals find it hard to pay all their expenses using their credit card. Usually the fee charge can be very high on some expenses such as a mortgage or your rent, pretty much making it not a wise decision to use your credit card. But with a line of credit, you can transfer the bank's money into your checking account and then use that money as cash. So what we're basically trying to do is use our line of credit to pay off our credit card, and then we use the velocity banking method to use our line of credit as our bank account. And you're going to do this by putting your paycheck into the line of credit, and then you're periodically going to be taking out the money in regards to the expenses that need to be paid during a certain day. Now, the thing is, some people may not receive a line of credit that is high enough to pay off all their credit cards at one time. So we're going to dive in and see what you should do if you have a low line of credit and multiple credit cards. Now, I know this sounds complicated, but you already know I got the whiteboard in the back, so we're going to get down to business. Let's go. All right, so we're on the whiteboard. We're going to be back with Credit Card Craig, but we're just going to have a different example here. So Credit Card Craig, his income is going to be $4,000. Expenses are going to be $3,800. Cash flow is $200 because income minus expenses equals $200. And Credit Card Craig is going to have 4 different credit cards. So credit card number 1, $1,000. We're going to say the interest rate is 20%. The minimum payment he has to put on that credit card is $100. Credit card 2 is going to be the exact same thing. Now, credit card 3 is going to be $1,000. Again, interest 25%. We're going to say the minimum payment is $25 on that particular card. And credit card number 4 is going to be the exact same as credit card number 3. Now, in this scenario, we're going to say that Credit Card Craig only got $3,000 on his line of credit. So he's not able to use his whole line of credit to pay off all the credit cards at one time. So we're going to figure out what Credit Card Craig is going to do when he has a smaller line of credit than all his credit cards combined. So we're on the other side of the board. So we're going to break down a pretty easy example so everybody can kind of get what we're going to be doing here. So with Credit Card Craig, the first step of what we're going to do, since we have a line of credit of $3,000, we're only going to use $2,000 because the $1,000, we're going to save that for emergencies, just in case something happens, right? So we're going to use $2,000 out of our line of credit. That's going to knock out 2 of our credit cards. And the credit cards we're going to specifically knock out are the ones that have a higher minimum payment that we have to pay. So we're going to do credit card 1 and 2 since their minimum payments are $100 each. So we're going to use our line of credit $2,000, and then we're going to put $1,000 on credit card 1, $1,000 on credit card 2. What this particularly is going to do is going to increase our cash flow by $200, and it's going to lower our expenses by $200. Because remember, our credit cards, those minimum payments are part of our expenses. Since it's paid off, it's not an expense anymore. So we're going to go to step number 2, the income. We're going to have $2,000. So $2,000 out of the $4,000 we have of income. We're going to use that $2,000, we're going to put it onto the line of credit to pay it back up to full, back up to $3,000. Now we're going to use our spare income of $2,000, and we're going to put that onto our expenses. Now, remember, our expenses was $3,800. Since it's minus by 200, they're only $3,600. So if we do the math, the 3,600 minus 2,000, we get $1,600 left in expenses. Now, the next step of what we're going to do, we're going to use our line of credit to pay the rest of our expenses. So since we have $1,600, our line of credit is $3,000. It's going to leave us $1,400 left on that line of credit. So if we look, the line of credit is $1,400. The debt that we have is $2,600 that we have to pay out, right? So we're on the month of February. So what we have to do is look at the end of January to see what our line of credit is. So our line of credit is $1,400. So we're wanting to pay that in full. Now we're going to skip step 1 because we're not ready to pay off another credit card just yet. So we're going to use $1,600 of our income, and we're going to put that onto the line of credit. $1,600 plus $1,400 equals $3,000. The line of credit is paid in full. Now, the next step of what we're going to do is use our remainder income, so $2,400, and we're going to put that onto our expenses. We see that our expenses are $3,600, so that means if we do the math, we have $1,200 left for expenses. Now, how are we going to pay that off? Easy. We're going to use the bank's money, our line of credit, and we're going to pay off the $1,200. We do the math. We're left with $1,800 on our line of credit for the end of February. Our debt's going down to $2,200. So if we see our cash flow is $400 and our line of credit is pretty much building up to the $400 every single month. All right, so on the month of March, so what we need to do here is we're going to look back at the end of February to see what our line of credit is. So our line of credit is at $1,800. We want to fill that thing up. So we're on step 2. We're going to use $1,200 of our income, put that onto the line of credit. It puts it back up to that $3,000 where we paid it off in full. Then we're going to use the rest of our income and we're going to put that onto the expenses of $3,600. So if we do that math, we're going to get $800 left on expenses. How are we going to pay our expenses? We already know we're going to use our line of credit of $3,000 and pay the remainder of our expenses. That means that our line of credit will be $2,200 here. So the end of March, $2,200, debt is $1,800 left, right? So we're on the month of April. So what we're going to be doing, we have to see what our line of credit was at the end of March. So our line of credit at the end of March was $2,200. So what we're trying to do here is put the line of credit back up to full, back up to $3,000. So we're going to use $800 of our income. We're going to throw that thing onto our line of credit to pay that thing off in full. We're going to be using the remainder of our income, $3,200, because remember we get $4,000. We're going to put that onto our expenses. Now, if we do the math, $3,600 minus 32, we're going to get $400 left that we have to pay in expenses. So after we do that, we're going to use the bank's money, our line of credit, to pay off the remainder of our expenses. And the remainder here, we're going to have $2,600 onto our line of credit. So at the end of April, we're seeing $2,600. Debt is going down $1,400 here. So again, we see that the cash flow for our line of credit is going up $400 every single month. All right, so we're on the month of May. So what we need to do here, we got to see what our line of credit was at the end of April. So if we look, our line of credit at the end of April was $2,600. So you already know we got to pay that line of credit off. So we're going to use $400 of our income. We're going to put that on to the line of credit. That's going to make it $3,000. We're going to put it back up to full, right? We're going to take our next step, the remainder of our income. We're going to be paying our expenses throughout the month. So we're going to be putting $3,600 on $3,600 of expenses. Easy math, that's going to be zero. So with zero, we don't even have to use our line of credit. That means that our line of credit is back up to $3,000. So we paid off both of those cards within the span of 5 months. All right, so we're in the month of June. We paid down our line of credit. So guess what? We're ready to pay off some more of our credit cards. Now, one thing to remember in a real life scenario, since we're be putting minimum payments on the other two cards, our debt should actually go down. In some cases, it could go up if the interest rate is very high. So just know that the $1,000 isn't realistic because within those 5 months, you were paying the minimum payment. So it's either going to be up a little bit or it's going to be down a little bit. But we're just going to put it in like a perfect world, make it a perfect scenario. So just remember that these two credit cards, the balance on them are going to be different. So with that being said, we have the two credit cards that are $1,000. Guess what we're going to do? We're going to put $2,000 of our line of credit and we're going to pay both of the credit cards off. So credit card 1 and credit card 2. Now we see that the minimum payments are $25. So that means that the cash flow together is going to be $50 added to our cash flow, and it's going to minus our expenses by $50. So we're going to go to our next step. Since we use $2,000 of our line of credit, we're going to use $2,000 of our income to put that onto the line of credit, and we're going to pay that back to full. Now, once we do that, we still have $2,000 out of our $4,000 to pay some of our expenses there. So our expenses now are $3,550. We do that math, it's going to be $1,550 that we have left in expenses. Now, how are we going to pay the rest of the expenses? We already know we're using the bank's money, our line of credit, and we're going to pay the remainder of our expenses, which leaves our line of credit at $1,450 for the end of that month. So we look at the end of June, $1,450. Our debt now is zero just because we wiped out both of those cards. All right, we're in the month of July. We paid the credit cards off, so that's a relief, but we have to get our line of credit back up to full here. So we need to take a look at what our line of credit was at the end of the previous month. So if we look, the previous month, we ended in $1,450. So what we're going to be doing here, we're going to put our line of credit back up to full. We're going to need $1,550 to put onto our line of credit to put that thing back up to full, back up to the $3,000. Then we're going to be doing the next step, our remainder income. We're going to be paying our expenses off with that. So we see that the expenses are $3,550. Remember, $50 below because we paid off our credit card. So that's no longer an expense. So if we do the math for our remainder income and our expenses, we get $1,100 left on expenses. Now, the next thing we're going to do, we're going to use the bank's money and we're going to pay the remainder of those expenses, which leaves our line of credit at $1,900 for the month of July. Our debt for our credit cards are zero. All right, we're on the month of August. We're almost wrapping this thing on up. So let's get it pounded in your head how to do this here. So we got to look at the previous month for our line of credit. So if we look at July, it looks like our line of credit was $1,900. So we need to be putting $1,100 of our income onto the line of credit to pay that thing off in full, back up to the $3,000. Once we do that, we're going to be using our remainder income of $2,900. We're going to put that all towards our expenses. We do that math, we see that we have $650 left on expenses. Now, how are we going to pay that off? You guessed it. We're going to use our line of credit, the $3,000, and we're going to pay the additional expenses off. This is going to leave our line of credit with $2,350 left. All right, we're in the month of September. I know we already got it down, but let's get this knocked out here. So we have to look at the previous month here. So we're going to look at the month of August. Our line of credit ended at $2,350. So what are we going to do? We're going to put $650 onto our line of credit. That equals the $3,000. It's going to put that thing back up to full. Now, the second thing that we're going to do, we're going to use the remainder of our income, the $3,350, put that onto our expenses. We do the math, $200 left in expenses. Now, how are we going to pay those expenses off? We already know, use our line of credit of the $3,000. We're going to use $200 of that. That leaves our line of credit at $2,800. Now, I know you guys are saying, Charles, you didn't finish it all out. And I understand I didn't. There's one more month, but hey, this board would have been so small. So just note that, don't kill me that I didn't finish it off, but I think we had enough examples where we know what to do with multiple credit cards and a smaller line of credit. Now, some takeaways here is, with our line of credit, we only used about 2/3 of the line of credit because we want to have at least 1/3 for emergency purposes here. So with the $3,000 line of credit, yeah, ideally you can pay credit card 1, 2, and 3, but we just did 1 and 2, had a little safety cushion, right? The other takeaway here is too, when you're doing a couple cards at a time, you're still paying minimum balances on the rest of the cards, which ideally should be pushing the balance down slightly. So when it's time to pay off these other cards, it's not going to be that same exact amount. So I know this was a very simplistic example. You're going to have to tailor it to your own situation, but I just want to make you guys aware of how you would do this if you have a situation with a low line of credit. Now remember, if you guys like this video, definitely smash that like button. If you're new to the channel or just haven't done so yet, please remember to hit that subscribe button for me. And always, I do appreciate a donation for my Patreon page if you enjoy my videos. And like always, you guys have a good weekend. Peace out.